My name's Matthew Kibben, and today we're talking about the Financial Services Royal Commission, which came to a conclusion about 10 days ago after a long and arduous period. And to have a chat about it, we've got Ben Rundle from NAOS and Michael Wayne from Medallion. Welcome, gentlemen. The Hayne plane landed last week, Ben, and didn't seem like there was a lot in it for the banks. No. Is that the way you read it?
Yeah, I think the banks certainly got off very lightly. I think, through the whole period of this Royal Commission, the banks have really had the screws put into them, which has slowed credit growth significantly. I actually take the view that that's what's caused the sell-off in housing prices and the flow-on effect from that being consumer confidence. Now that the Royal Commission's over, the banks are probably sitting there thinking, well, we got out of that pretty well. I think the reputations of the Big Four are probably okay. And now they can get back towards expanding credit growth. And also, too, you've got APRA, who are now have removed their restrictions on investor lending as well. So I certainly think, for the banks, they'll be sitting there thinking, well, now we're in a pretty good spot where we can finally find some growth again. Well,
hold that thought. We'll come back to that. Michael, so are you as bullish, and is it the outlook for the banks a bit rosier than what it has been? Because they've really screwed down on lending, haven't they?
Yeah, look, they'll certainly be relieved with the recommendations that were made. There was no doubt they were marginally better than many of the expectations that were built into markets. But I do think the outlook still remains challenging. The risk and compliance frameworks are going to be a lot more challenging. The costs that they're going to have to go into those sorts of things might well distract them from their core modus operandi, which is generating revenue and sales growth. So although the recommendations weren't that harsh, it's going to have, I think, lasting implications on how these businesses are run going forward.
So if we look at the Big Four, which were under scrutiny the whole time, and we saw the NAB, a few fallen soldiers post the commission, is there anyone that stood out that should do well, or is it they all in the same boat for the moment?
Oh, look, I think they're much of a muchness barring the NAB, except probably ANZ is in the best position at the moment. Their net interest margins, I think, are in the best position to benefit from prevailing interest rates at the moment. Their cost growth is actually meant to fall, and I think that's the only one of the Big Four banks, which is interesting. So I'd probably have to go with ANZ. The capital position's the strongest of the Big Four at the moment, given they were first to go with divesting certain non-core assets. But otherwise, I think CBA is still in a very good position. They've probably done a lot of their expenditure and getting their costs up and investing in things like technology well in advance of some of the other banks. Okay, so Ben, you sounded pretty bullish.
Yep.
Have you got one, two, or do you just group them together and say just buy the sector?
No, well, as a value manager, and I will cop some criticism for this, I would actually buy NAB of all three. I think the management change will be a good catalyst for them. Yes, there's cultural issues inside the business.
We're going to get a dividend cut?
There potentially is that possibility, yes. So, but I think you're getting a 30% discount in terms of a PE valuation to the leader in CBA. And I think, with NAB, they were the last ones to adjust their standard variable rates higher. So I think you'll get a little bit of an earnings kicker next quarter. It's non-consensus. It's the riskier one to buy, but I think on valuation and potential outlook, I think that's the one I'd own.
Now, the Hayne plane, though, caused a bit of collateral damage. There were other sectors, especially brokers, mortgage brokers in particular. How do you read that? He's basically pulled the rug, or the recommendations pulled the rug out from that industry. Should we be looking there around the ruins?
I think it's a great industry to look at. I mean, I take the view that I don't think the government will completely remove this industry. My view is that mortgage broking is very good for the consumer. There are other markets where the revenue model is a little bit different to how we do it in Australia with the trail commissions. So while someone like AFG will have to adapt their business model, they do have time to do it, because there's a working group that I think will monitor this situation for the next 2 or 3 years. You've got a trail book there which sort of underlines some of the current valuation and gives you a bit of a margin of safety. But it's peak pessimism against this stock, and I do think that the industry will continue to exist, and I think it will continue to favour the larger players and the smaller ones will drop out.
The Hayne planes seem to just gobble up what Commonwealth Bank and Westpac were putting forward about the poor old mortgage brokers. We've got a couple that are listed. Do you think that the Hayne recommendations of making the consumer pay, taking out the trail, will happen? And two, if so, what do we do with these two listed companies?
Yeah, look, it's certainly bottom feeding at the moment. Pessimism is at peak, as Ben's been sort of pointing out there. You have to be pretty game to step up to the plate, just because I still think it's a bit of a moving feast. I think it depends on whether the Liberal government retains power, or whether Labor gets in, who've come out pretty strongly against this at the moment. But there's no doubt that if the borrower is forced to pay as opposed to the lender, people are going to think twice about using mortgage brokers.
Back to the banks.
Back to the banks, back to the bank branches. The fact that trail is being cut makes up probably 30, 40, 50% in some cases of the mortgage broker's income. So it's going to have some big implications long term. Whether or not the upfronts get pushed up in order to compensate the mortgage brokers for the lack of trail, these things will have to be nunned out by these businesses, and I just think there's not enough clarity at the moment to step up to the plate and pick up, say, an AFG or a Mortgage Choice.
And do you reckon we saw one winner from the whole commission?
Look, I think you'll have to go with the wealth managers probably. The vertically integrated business model was being called into question. Having an internal financial planner recommending internal insurance products, internal funds, there is a lot of conflict of interest. And
Too hard to unwind though, he said.
That's the problem. This is pretty well entrenched throughout the financial services industry. And if you start pushing up costs too much for these sorts of wealth managers, it might sort of deter people from going to get advice altogether. So I think the wealth managers probably got out of it the best, because at some points there, the likes of AMP, the likes of IWF were threatened by the fact of being broken up. But that's not to say that APRA or ASIC won't come after these organisations elsewhere. Just because the Royal Commission's ended and the recommendations have come, doesn't mean that there's not going to be something that pops up out of left field, as we've seen already with IWF and AMP.
Yep, and we're in the game of picking winners and losers, Ben. Was there, out of the Royal Commission, was there a winner?
I think the big four banks were the winner,
Yeah.
genuinely, yep. And I've said that I'd own NAB out of the four.
Well, the Hame plane landed, but it doesn't look like it caused too much damage. It was a smooth touchdown.